Speaking of gambling here, so when it comes to earning seasons, so how do you approach automated trading strategies during earning seasons? Let me just ask it this way. Some people are when I used to trade earning season specifically, I was actually looking for outsized moves against what the market was positioned. So I wanted to buy options that I wasn't paying a lot for, and that I had some reasonable expectation that there was a chance where the earnings was better or worse or whatever, and I was placed on the other side, and I really like that. But then I know there's a bunch of people with automated strategies. I even see this with brokers for volatility events, where the idea is not to trade, like to pause your strategies during these periods where you can't. There's no trend, right? The trend could drastically change because of new information that comes out. Is that how you think about it?
Yeah, it totally resonates. I think that ultimately you build your strategy with these types of concepts built in, right? You're taking these things into account. So on one side of the conversation, you might be in the camp of people who believes that I've already incorporated all these things into the history of my strategy. If I built a daily strategy that trades, that's been trained on the last 22 years of data, well, then obviously I've incorporated every FOMC event, every earnings call, every change in the market, every regime, and so forth. And so I'm incorporating those events into my strategy and have already accounted for them. And I'm comfortable exposing myself to those events because that's part of the results of the strategy. It would be the same, when if you're a dollar cost averaging buy and hold type of investor, that's effectively the thesis you're buying into. I'm buying the market and all of the events that come with it. Now, if you're the type who believes that I want to avoid these types of events because I don't want that volatility in my account, and avoiding that volatility is what helps me increase my edge, then you will need to program that into your strategy. But you have to make sure that you've done it with all the events historically, like every one of them, and you didn't skip any of them, so that you can confirm that avoiding those events is what led to your edge. So either way, either camp you're in, you just have to make sure that you've incorporated them and not given yourself a false signal. If, for example, you built your model with all the events historically, but then suddenly started avoiding those events, we don't know for sure whether avoiding those events actually led to a decrease in your performance.
Fair enough. I didn't even think about that. Right, right. That's exactly right because the data set included those earnings seasons.
Sure.
Okay.
Right.
Yeah. Actually, that makes a lot of sense. Do you personally, if I'll ask, do you this event-based trading? Do you like having strategies that are trying to take advantage of earning seasons?
I've tried. I've tried a couple of like hedged based future strategies that are based around FOMC events. They're really choppy. They're really difficult to get right. They're fun, but not really my style. I've just kind of dabbled in it more than anything. Um, Earnings are important to one of my more long term approaches, but they're not necessarily a trigger for a trade. So if a number of companies start releasing earnings and it results in a sell off, that sell off might already be incorporated in sort of the long term expectations I have from that holding. But if the earnings call makes a significant change in the fundamentals of that business, along with technicals, that might change my opinion about the holding, and I'll exit the position at that point. So it just kind of depends. Like most of my approach right now is buying index funds, which I don't have to worry too much about fundamentals on because it's kind of baked in. So I focus mostly on price to earnings there, like the overall market price to earnings. And then mostly look at technicals. So when I see a technical crossover, that's when it's time to get out. And interestingly, I saw a technical crossover earlier this week and exited my entire XLK position.
Wait, you're not long tech right now?
I'm not long
Goodness
tech right
gracious.
now. Yep.
Jiminy Cricket. Well, what I like about what I used to like about earning season trades was that the business cycle, even the liquidity cycle, earning seasons was affected way later because it takes some time for that to filter through the businesses. And so at the turns of the cycles, you can a lot of people are positioned offside of where the earnings should be, and then you get these surprises either to the downside at the beginning of a recession or the opposite at the bottom. And there's also something so satisfying of Everyone's expecting this to keep going up, but you bet that it's go down, and now you made 10x on the some options trade on the downside. The problem I had was that why I stopped was the rebounds that would happen. Like I guess liquidity profiles for the markets has changed over the last 5 years, that you can get a complete reversal of whatever move happened right after earnings. So it's like, well, how long do you hold your options? And there's nothing so painful to me as having a position where I'm up a certain amount, take profits, and then it continues to run. So then I go, well, I don't like this. I never know when the bottom's going to happen. Sometimes it could happen on a dime, and it was just too painful to win, but not as much as I could. And so forget it.
I totally get you there. And I've been there plenty of times, exiting positions too early, and then the market just continues to rally like crazy. Pulling a stop too soon, and there ended up being a reversal, or taking the stop too soon, and it ended up reversing immediately after. If I had held, it would have been a winning trade. This is the game we play, though, when we try to time the market, and we're not always correct. So we just want to be right more than we're wrong. So keep at it.
And you can't brag. You can't brag to anybody that, hey, I did this trade. You'd be like, oh wait, that trade that actually went 3 times further than you did?
Yeah, right.
Oh, okay. So you're just a coward. You can't even, why even bother? You're happy with 7%. That thing moved 30%. I was like, oh my God. All right. Well,
if that's how I measured myself, I'd be a pretty depressed individual. So unfortunately, I don't use outside opinions to measure my portfolio performance.
I see. Well, by outside opinions, I mean my wife.
Oh, right. Yeah. Got to keep the wife happy.
Yeah. She looks at the chart and she goes, you've been watching this for the last 3 months, and the trade finally happens, and you got 1/3 of it. Yeah. All right. Back it up. Go to something else.
Yeah, my wife, as my advisor to my portfolio performance, is always the type who's like, why did you even sell in the first place? Just hold forever. She's very much a hold it forever. And that's mainly because of my 2012 Amazon investment that was fairly large. And I pulled it like 2 years later, maybe 2.5 years later. And I should have held that forever, obviously.
Oh my God. Yeah. Yeah. I had Tesla stock early on too. And then it was like, I guess I got confused. Not confused. I got into the hype of short Tesla, short anything EV cars, and then I started shorting the stock. And every single time I shorted, I lost. Every single time, all the way to the top.